Well, thank you everyone for joining us today. We will try to keep this fast and moving, given that it's late in the afternoon already, and I'm sure many of you have traveled in today. If we could start with like a round of introductions, I'll just start briefly. Purvi Maniar, I'm the Chief Legal Officer at Laser Digital. We are a subsidiary of the Nomura Group, and we're focused on institutional products in the digital asset space, primarily on the trading, asset management and lending side. And in the US, we're in the process of seeking conditional approval to become a national trust bank.
Great, and hi everyone, I'm Maredith Hannon. I lead business development for WisdomTree's digital assets business. We're a $150 billion global ETF and ETP manager who over the last 5 or 6 years has really focused on tokenization through both a retail platform called WisdomTree Prime and an institutional platform called WisdomTree Connect. We have the largest suite of tokenized funds of 15 products that are publicly available to both retail and institutional investors. And I'll talk a little bit about the utility and also the use cases that we've been focusing on. So thanks for having me.
Good afternoon, everybody. My name is Duke Kim. I am the Director of Institutional Solutions at Securitize. What that means is I drive both fund administration conversations as well as tokenization conversations. Securitize is one of the leading RWA tokenization platforms, best known for having brought BlackRock Biddle, a tokenized money market fund, to market that sits at about $2.5 billion in AUM. And across a number of other vehicles that we brought on chain, we sit at about $4.5 billion issued so far.
Thanks for all you coming to sit here instead of networking upstairs. We appreciate it. These are the most comfortable chairs I've sat on. Usually they feel kind of fake. Can you all hear me? Should I talk louder? I'm getting... Adam Levine, CEO of Fireblocks Financial Services. Fireblocks is digital asset infrastructure. We're proud to power many of you amongst 2,500 other clients, and tokenization is where it's at.
Great to connect, and super excited to be on this panel. Aya Kantorovich, co-founder, co-CEO of Upshift, one of the leading vault providers. When we think about tokenization, once an asset is tokenized, you think about yield, product market fit. That's where we come in. And yeah, excited to dive into what that really means in practice today.
Okay, thank you. So I'll start with a softball, which is just what's your favorite use case that you're seeing today? And we can just go down the line.
Sure. So I think we actually have had 2 in the last week, which has been really exciting. It's really a focus on, we primarily focus on a tokenized money market fund. It's about taking that cash drag and that unutilized cash and actually putting it into practice where it's yield generating. And I think a lot of us will talk about that. So whether that's payroll, so getting paid in money market fund tokens, or whether that's you're a small or a mid-sized business who is using a checking or a savings account today, not really earning or utilizing yield and trying to do cross-border payments, or even just paying other vendors on how to utilize a money market fund in order to do that. So I think both of those are really key use cases for us, in addition to retail investors wanting to, in one consolidated app, hold Bitcoin, Ether, a money market fund, a WisdomTree 500 product, a private credit product, and do it easily and seamlessly. So really our focus is providing new utility to these tokenized assets, but also really abstracting away the difficulties of blockchain technology and infrastructure and having that sit behind the scenes and enabling the end investor to just have a better investing experience.
I'll be somewhat boring and largely agree with what Meredith said, right? But to take it up a higher level, it's really about enabling yield-seeking behavior, right? It's allowing both institutional investors, retail investors to make more money with their money. But all the stuff that we're doing in DeFi is traditional capital markets primitives, like borrow and lending, prime brokerage on chain, which is looping. We have to add new names for everything. But these are all existing workflows, faster, more seamless, still compliant, using tokenized fund shares or tokenized public equity to do the things that you can do in the traditional world, again, just a little bit more fast, a little faster, a little less friction, and really unlocking some of that wealth and the wealth access capabilities via DeFi versus kind of traditional workflows.
Yeah, look, the tokenized funds is obviously very well known. It's great, no exceptions. I get excited about not just the money market funds, but funds that are natively tokenized and some of the things you're seeing with equities, not because what we see today is necessarily going to be the answer, especially for institutional adoption, but it's starting to push the envelope. So that's where I'm getting really excited.
As the last person on this, I will obviously agree with everything that was being said, but I will also add to it in that, traditional markets are moving to a 24/7 world, and users, if you look at just the liquidity and activity that's happening on something like a hyperliquid perp market, you're seeing that there's clearly users that want to trade an opinion over the weekend when markets are, for example, closed. Traditional markets are closed. And so how do we move a lot of these assets to trade 24/7? So you're seeing a lot of that push happen in tokenization. A lot of the assets that people want exposure to, the folks on this panel, are tokenizing natively, to your point. And so that's very exciting. I think one of the things that are is still missing is, as you mentioned, Meredith, utility. These things are not always 24/7. There is duration mismatch in a lot of these assets as they come on chain. And so how do you make them trade in a 24/7 capacity, enable the credit markets on top of them, make them transferable and composable across whatever blockchain or platform that you're using them. And so that's really kind of the product market fit that we haven't seen fully unlock yet that we're most excited about.
So if I could pull a little bit from some of the themes that I think all four of you brought up, where in your conversations do you see the friction? So I think, Meredith, you pointed to just the operational layer behind the scenes. I think, Aya, you touched a little bit about like the 24/7 nature, but also like there's obviously a regulatory component to this as well in terms of the usability across a number of different, whether it's venues, use cases, et cetera. Where do you all see that friction coming up in your conversations, and how are you solving for it?
I'm happy to start. I think for us, the friction is on two sides. It's predominantly, though, in the distribution fund. So that friction is there's $8 trillion worth of money market funds today. There's 2 billion that are tokenized. So I do think that that friction is the access point and the interface, which is what I was alluding to before. But I also think it is utility. So something that we're focused on is in order to bring that 8 trillion on chain, how do you do that? It needs to be a better investing experience. It needs to have new utility, and it needs to be effectively a step function above what you can get today in your brokerage account. So 2 examples of that we've recently launched has been continuous interest accrual, meaning you're continuously, block by block, earning interest. So that means on a Saturday, if you sell out of the fund, you'd be able to earn interest from that Friday night to Saturday morning. But then also 24/7 trading. So we are the first, we got a SEC exemptive relief to be able to trade our US Treasury money market fund 24/7. So that also is inhibiting or really creating more trading for whether it's stablecoin issuers, whether it's crypto natives, or whether it's even, again, small to mid-sized businesses who want to gain access to this because they're in different time zones. So I think that's really the key part of this is from a distribution and a friction side, it's bringing the traditional base into now the on-chain infrastructure in a really seamless way.
On the distribution point, I think part of the challenge, because I think distribution is one of the biggest issues the industry has, is that it's not just about one market, right? So for many of this, it's about giving emerging markets access to assets that most of us in this room and the institutions we work for can get access to quite easily. We could definitely argue why it's better when it's tokenized versus not, but it works pretty well. But when you're in an emerging market trying to get access to some of those assets, it's difficult. And then in reverse, if you're trying to get access to some of those assets in emerging markets, it's not so simple, right? The SEC is taking some guidelines recently about whether or not you need to be a broker-dealer in order to provide that really good venue to be the distribution. I think there'll be challenges as we look at the different markets because of the cross-border nature where it's really going to excel over the next few years.
We were told to throw some hot takes out there just because it's also an afternoon panel. So I'm going to, don't want to be a douche, like removing or pulling and like really diving into like what distribution actually means, right? Or like we all say that, there have been multiple panels today talking about that's the big problem, that's the opportunity, distribution, distribution, distribution. I think we actually need to be a little bit more clear about what that means or what the real friction points are. For me, when I talk about Securitize and broadly with Meredith, an agreement of like, hey, we want people to do stuff with their stuff. We want yield-seeking behavior. We want prime brokerage on chain. It has to be a better version. A tokenized fund share has to be a better version than the paper version. Great. All the investors here, if you have MetaMask wallets, Exodus, you're comfortable taking a tokenized share, right? The rest of the trillions of dollars that are off-chain, right? How do we get that next comma on-chain? There we go. How do we bring that on-chain? It's distribution, fine. It's really about things like custody and passported like utility from a KYC perspective. Because right now, if you're brokered traditionally with Fidelity, that gives you pretty much access to whatever you want to get a hold of, right? If you want to go on chain and start investing in on-chain tokenized funds or tokenized equity, it's, well, you got to sign up with WisdomTree. and Superstate, and Securitize, and Centrifuge, and some other people that I'm not going to give airtime to. So then that becomes really problematic and super fragments the investor experience and that liquidity profile for what all of us want. So it comes down to ideally some sort of utility for KYC, but also a real retail custody solution for investors so they don't have to worry so much about all this crazy DeFi stuff and the operational controls that are required to manage significant amounts of capital with your keychain. Like that's a real problem for real institutional money to come on board.
And I'll even take it a step further because I love a good hot take in the afternoon. So Duke, I'm glad you started it. I would say too, like we're really going to meet some of these brokerages, in my opinion, halfway. Because at the end of the day, if you think about why are people getting excited about some of these tokenized assets, at least the users that we're talking to, it's because someone like a WisdomTree, someone like a Securitize are now able to expand their products into user bases that weren't typically accessing their products before. So if you think about some of the largest holders of BIDL or USTB, these are maybe crypto companies who their user bases are not naturally in the US. They're geographically all over the globe. And so these are not typical USTB holders or even like BIDL holders. And so the expansion of that user base is really, really important. And so if you think about where those users are too, maybe they do want to trade in their Fidelity, maybe they still want to trade in their brokerage accounts, and we'll probably meet them halfway in the same way that we're seeing a Coinbase and a Robinhood kind of meeting in this halfway point that I always talk about. It's a very similar metaphor. Who's going to trade tokenized equities first? Is it going to be Robinhood enabling 24/7 equity trading, or is it going to be Coinbase enabling 24/7 crypto equity trading? And we're going to see the same thing happen on other tokenized assets as well, where we'll likely meet halfway, and we're going to have to meet some of these users wherever they're trading today, because it's going to be very hard. You talk about what is distribution. It's going to be very hard to steal that retail user, to steal some of these users away from whatever wallet, neobank, or platform they're using today. So how do we make that more seamless and easy? And at the end of the day, they shouldn't even know what the term tokenization really means. I think we love nomenclature in crypto, but at the end of the day, it's just a 24/7 trading asset. It's an asset that already trades in traditional finance, and hopefully we can meet them where they are in terms of their day-to-day user base.
I think, yeah, and maybe pulling a little bit from there, like when we talk about like friction, I think the other area where this comes up quite a bit is like, it comes down to this question of, okay, you have something tokenized, you do the right things from a regulatory perspective. So you've put the gates, you've put the restrictions on it, but what happens when it meets DeFi? And how do we solve for that? If we're thinking 24/7, we're thinking distribution, we're talking about access and availability, as we see markets increasingly moving to DeFi protocols, how do we solve for that?
Yeah, I can take it for a step. Look, I think the KYC thing, without a doubt, is an issue, and I do think that there's a number of users that are trading in DeFi today that are happy to KYC, as so long as that KYC process is not, the institutional multi-week, multi-month, sometime really strenuous process of going through a full KYC. Some products have done a tremendous job of this, where it's a very quick, face scan, upload 3 documents, good, you're done. And now you have, as Duke mentioned, like a KYC passport. I think on the institutional side, it can be very, very painful, and that's kind of where we've seen, this drop off in products that are enabled in a DeFi sense that are highly regulated. But I do think that, if the distribution path is the best way forward, because you create almost a silo of, let's say an exchange offers a product, and that exchange already has full KYC. Some of these are already fully regulated in certain jurisdictions, and now you enable a market that accesses or provides liquidity. For example, the Morpho CBBTC market, right? That market itself, I think, is around $2 billion. And so now you enable this area of liquidity, and we've seen DeFi try to silo. I still think that's possible, but you have to create a very seamless user experience where, okay, you have this market, how do you make that composable with another market? And we talk about fragmentation a lot. Chain fragmentation is a really big issue, and so how do you create a layer on top where people don't have to think about the chain, think about the protocol, or think about what platform they're trading it on. And honestly, that's where we've seen vaults really step in, because you can aggregate all of that in one place. You can get a levered tokenized fund, you can get an index, you can get an ETF-like product in one place. It's fully KYC'd end to end. You don't need to have access to all of these different random protocols and chains. So it simplifies that user experience in one place.
So thinking about some of the regulatory concerns you're asking about, right? There's KYC and KYT. And so at Fireblocks or Fireblocks Trust Company, our qualified custodian in the US, we're speaking to institutions exclusively. And RWA comes up, and it's RWA followed by DeFi. It feels like alphabet soup with just slightly different letters. And it starts off from a place where it's the institutions that are fully crypto native, but just traditional enough that they need a custodian, right? And they're coming to us saying, I want access to RWA in my custodian, can you do that? Then I need it in a DeFi pool, can you do that? And so we think a lot about the KYC, and there's solutions out there. Some of them are painful, and the number of times you have to text the MD at a certain place, send me your freaking passport picture, right? Like, those things continue, but there's better solutions coming, and I think you'll see on-chain ID from people like Fireblocks and others soon. But then there's the KYT, and that's where we find that regulators have that immediate visceral reaction of, and one of the panelists in the prior panel mentioned, like, you don't know who's on the other side. Sort of, right? Like, if you think about, at least in the concept of Morpho and what the curators do, they're able to put certain guardrails on to make sure that, to the best of their knowledge, using really sophisticated solutions out there, that it's unlikely to be North Korea or Myanmar on the other side. We found engaging with the regulators that they're very open to this conversation. So at least the conversations we're having, the regulators are excited about it, and they're not excited about all of it. But there's definitely ways that you can start to attack and provide a way for institutions to leverage RWAs, access DeFi, and I think you'll see more news on this soon. But you have to engage with the regulators and bring them along. We've tried of saying, like, here's the whole arc of everything we eventually want to go to. We're starting here in step one. Right? And they definitely don't love the long-term vision, and we may not be able to do all of it, but they like step one, and they're okay with the next few steps, and that's no different than traditional finance, where it's the same regulators that are going to say, no, you can't do all that wacky stuff, but yeah, the first half a dozen steps, let's talk about it.
I just want to quickly mention one, KYT means know your transaction for folks who don't.
Yes.
Yeah, and okay. And the second thing is I really want to anchor on what you said, because again, DeFi historically has said we want to aggregate everything and make everything accessible, but what you said is siloed markets, right? You silo the area that maybe is KYC'd or has the additional like transaction monitoring on top. Very different from the kind of initial anarchist view of what DeFi needed to be, but to the point on actual distribution, regulatory approval, the direction we've seen a lot more appetite for, especially after what happened with Aave, for example.
Yeah, I think those that want the full DeFi are also with the unbank yourself people, and that's unlikely to be where the institutions win.
Right.
Right.
100%. Yeah.
Yeah, there will be a maturation of DeFi, or maybe even like a segregation or bifurcation of DeFi, right? So there are both the full-blown degenerate, sub-30-year-old that really just grew up on-chain fully, and they're comfortable as much as they say they are with, again, having all their wealth on a keychain. That's fine. But when you talk about true institutions coming in, again, where are you going to get the extra comma to come on chain, building almost a completely different infrastructure stack just for those participants. Earlier this morning, I was sitting on the Vault roundtable upstairs, and one of the people that you wouldn't have ever thought to say these words said, well, maybe the Vault participants actually need to create an SRO. Right? There may be some level of just self-regulation, all of us just preparing for true operational, like to survive operational due diligence scrutiny of like traditional allocators. We have to really up our game. And that's across the board. We've all figured out, broadly speaking, I think the argument was made, we were all worried about smart contract risk over the last year. That has settled down. There are enough companies out there that do audits and continuous audits and all that stuff. But all of the problems that we've seen throughout the month of April, right? And someone on X was kind of bandying about every other day there was a hack or a problem. These chairs aren't incredibly comfortable. But it wasn't, they weren't failures of a smart contract. They weren't failures of DeFi. They were failures of operational control. Like, it's just human errors, Web 2 problems that have resurfaced in Web 3. We should have known. And if we're expecting to bring real capital on chain, let's accept that and do something about it and get fully prepared.
Okay, great. So I guess maybe shifting gears a little bit. So when it comes to stablecoins, we're kind of seeing a convergence around yield, not a possibility for stablecoins in the US and in the EU. What has that done for adoption of other asset classes being tokenized? Like where do you see that, particularly when we talk about ex-US as well?
I'll jump in. The stablecoins are the gateway drug, right? That's how it works. We talked very early on about the product market fit of the tokenized money market fund because they have a version of dollars at rest, right? Whether it's for an hour or for a month, right? They're not looking to take the stable, convert it back to fiat, then get the interest, then do it in reverse, right? It's the very obvious first step. At Fireblocks, we're seeing tremendous adoption, and it's obviously in the markets that have more difficulty getting access to dollars, but increasingly it's not just those markets. And those are the ones that are now starting to explore versions of tokenized funds, tokenized equities, and more. So the stable coins are fundamental. And what I'm expecting to see, and we're seeing some of this now, is non-US dollar stablecoins, right? Which also feels obvious. There's needs for it, though. And whether it's the consortia recently announced we're supporting in Europe with the Euro coin or other markets, it's where the direction has to go to help bring more finance on-chain.
I would agree. I mean, we're at the Yield Summit, so obviously focused on yield, and I think that's why tokenized money market funds have been such an obvious one too. But then as you start to think and go out the risk curve, I think that's why private credit more and more has come up, but even just fund structures in terms of how can you get a large cap US 500 on chain and be able to access it in a really simplistic way. There's obviously the KYC problem too that I think is a huge one for us to solve, but I think it's going to be more yield-bearing assets where now, I love that it's a gateway drug of here's payments, here's an easy way to really start the commerce train, but then how do you start to think about what that does for you when it is sitting at rest? And I think this is where what tokenization can really bring is the elimination of cash drag, and I think that's going to change how allocators and LPs really operate.
I like that, yeah, we're at the Digital Asset Yield Summit, and so let's talk about yield and what we've probably seen from like the issuer, working with issuer, being an issuer, right? What's made sense on chain so far? Great, money market funds, AAA CLO products, low duration, no duration type products, because again, if you're a fully on-chain person over the last several cycles and generations, you've been beaten up by FTX, Celsius, Terra Luna, like every awful thing that's occurred, right? We're talking, like we kind of joke, like, how long have you been in the space? How much money have you lost, right? No one ever asks, like, how much money have you made? We all know we've lost money, like on something that was kind of out of our control, right? So on chain, what's made sense so far is no duration product, and my urge is like, we need duration product. We need to not be so duration averse. We need sticky capital on chain, because when we talk about money market products, AAA, private credit on chain, the questions that buyers come to us and ask our product sellers about is, what's the exit liquidity? What's the redemption liquidity? How quickly, when do I get my capital back once I redeem? Great questions, very important to answer, but if the goal is higher yield, you have to be willing to accept duration at some point. And that's still not there because the buyer base are just battered children, sorry. Like they're just not ready for that. So when you have more capital coming on chain, more traditional investors, because we've solved distribution, KYC, custody of those assets, we'll get stickier capital, we'll be able to bring duration product on chain, higher yields on chain, and that makes the flywheel go faster for all of us.
Yeah, I would even add to that, I'm sure you're getting those questions too because people still view crypto as a risk asset. And so when they think about these tokenized assets, it's still on chain, there's smart contract risk, and in their view, they're looking for duration or higher premium because it is in their mind a risk asset, regardless if it's, the tokenized traditional form on chain. And so I agree with you, there's almost like a narrative breaking that we need to work on there, but then there's also a middle ground between a money market all the way to private credit where it's like, let's do equities and commodities. People want to trade equities and commodities. It's obviously a harder thing to do because of regulatory reasons, but if at least we've seen in the perp market, and you can even say the prediction market trades these assets as well, there's clearly a lot of demand for being able to trade that in a 24/7 way. And so there's no need to recreate the wheel. You said that, Fortune 500. I mean, there's so much demand, at least that we're seeing, where people are saying, hey, I don't want to lend to crypto companies. I want to buy corporate bonds of Apple and Microsoft. You know, like there's a full middle ground here between a money market and, again, like a very long tail risk asset that people want access to, and they want access to it on chain. And interestingly, to your point on Euro stablecoins, we're actually seeing a lot of equity and equity demand for Asia-based geos. I think people always thought, okay, we'll tokenize Apple, bring it on chain, and everyone's going to want Apple stock. That's not always the demand, at least that we're seeing. And so, yeah, it's very interesting to see what that demand is. But I think there's this huge middle ground that we just tend to forget. And a lot of it is because of reg reasons and because of the KYC reasons and distribution, everything we mentioned here today. But we don't really need to go between 3.5% to 12% 90-day duration without keeping in mind some of these assets here in between.
And that's been a big focus of ours too, is that even when I talk about private credit, ours is a liquid private credit product that is still trading like the underlying's trading in equity. To your point, you need to understand the underlying equity of the market, but it's still T+2 or T+3. So ensuring that those short timelines for redemptions are still met, I think are critically important as well. And I also think that there's also, to the 24/7 point, I think a lot of times, especially being I'm based in New York, you think about 24/7 trading, I get questions of who's going to want to trade at 2 a.m., right, in New York. It's not for you, it's for the person in Asia trading at 2 p.m. their local time. And I think that's where shifting to, okay, this is truly a global type of infrastructure change is an important one as well.
Yeah, I mean, if you think of the rise of hyperliquid and the fact that you can express a view on a weekend, or you can react to Trump on Friday afternoon after market close, that's critically important. When I got into the fund administration space at Securitize a year and a half ago, ex-TradFi guy, traded derivatives, corporate bonds for a number of years, I was very excited to see the beginnings of multi-asset, multi-strat funds launching. It's like, we're going to trade crypto, we're going to trade Bitcoin, Solana, ETH, and I want to trade a crypto company, and I want to trade straight up equity. Great. That hasn't really taken off still yet, much to my annoyance. But we're starting to see that really pop up more recently, where there are traditional market makers that are saying, hey, Securitize, we saw the news with NYSE, we're a market maker, blah, blah, blah. We want to be the market maker for tokenized equity now. We're a long short, we're a commodity fund. We got on the hyperliquid train, and now I can actually hedge out or express a risk view on a Saturday morning. That's also very important. So we're seeing somehow or another, right, people backing into this multi-asset, multi-strategy world, because for us, we're saying, hey, 24/7 is this great feature, right, and people want it. It's been an underlying demand, right? It's just not been possible. Like, I remember during the global financial crisis when Lehman was falling, I was called in on a Sunday to trade because I traded OTC product. We're making gigantic 20 basis point wide markets, and like no one's gonna actually trade, but we were trying to help other people manage risk to the best of our ability. Now we can really do that with these new rails, and that's gonna be, I think, powerful for all of us and unlocks a lot of opportunity for market makers and for fund managers, et cetera, and investors to have global access 24/7. It will happen.
So we have a few minutes left. I'm going to ask one last question, and then we'll do maybe a lightning round at the end. So I think, when I think about kind of what's greenfields in the space, interbank liabilities come to mind, tokenized deposits, any kind of interbank collateralization. What trends are you seeing there, and kind of what's your thesis around that?
I'll go first. I think part of the challenge that the industry has is they're used to everything moving so quickly because it's blockchain, right? We talk about 24/7, and they think it's not just the trading, it's the settlement. Making a trade, making a payment, making a trade, making a payment, it's asinine, right? But the industry is used to that. And then you take a boring bunch of TradFi people with gray hair and you're like, hey, the advantage of T+2 is all this netting capability and the collateral management, and you're using your dollar more efficiently. There are a few companies that are starting to solve these issues intelligently. Settling T+2 is still asinine, but the making a trade, making a payment doesn't make sense either. Those sort of solutions for institutions is what the market needs. That's going to unlock a lot more value. Like, there's going to be a certain give and take between the speed with which you can settle, right, the legal finality, the settlement of the transaction. So it's not instant, but you're definitely talking about it happening within maybe minutes or hours. in getting some of that efficiency, or making the decision that you want to maximize towards your collateral efficiency, but still not waiting T+2. I think that's what we're going to need, not in a crypto setting alone, but even if you're talking about your equities that you're trading or your corporate bonds or anything else, those solutions are essential. And then you need the infrastructure behind that that can provide the connectivity to custodians and the exchanges and those that are going to offer the true distribution with the compliance issue solved. That's when the market starts to change.
So really quickly to close it out, what shouldn't be tokenized?
Should not be tokenized?
Should not be tokenized.
Someone once asked me if they could tokenize their Laguna Beach house. I think that's fair to say. You don't need to tokenize that.
My favorite in my inbox still is a gentleman that bought a bunch of land on the coastline somewhere of Ireland that wanted to tokenize burial plots. I thought that was fun. It was like, well, Duke, that looks like a yield-bearing, like it looks like an income stream, kind of, it's very sticky. It's like, well, yes and no, but who on chain is going to buy the thing?
Right, exactly. There's no demand.
Broadly, though, I believe when people talk about the TAMs of various things, and like, well, look at the TAM of real estate, it's 400 trillion, we're going to tokenize that, that makes the most sense. I wholeheartedly disagree, broadly speaking. Like, I don't want to buy $100 worth of your house, Meredith.
Right, yeah.
I'm sure you have a quite lovely house. I don't think it needs to be tokenized. There's no actual demand for it, and still the paperwork still costs a ton, and there's like actual securities laws. High-performing commercial real estate can make sense if you squint. If I've talked to a number of groups that have lots and lots of mid-tier asset hotels across the U.S. It looks like a fixed income asset. High-quality underlying real estate spins off a stream of rental income or hotel income. Looks great. There can be a thing there. What I do tell people that kind of pop into my inbox is to sort of, if you couldn't find capital from the rich dentist down the street, you're not going to find it on chain. Like, there are strategies that just should not be tokenized. So I'm the anti-tokenization guy. If there are hype beasts here, I'm actually working on the anti-tokenization club t-shirt, right? Just because there's lots of stuff that everyone wants to tokenize, I'm like, it does not belong on chain. If you want to pay me, great, but you're not going to find any investors. There's no subscription. No DeFi protocol is going to take it. No vault is going to want to do anything with that thing. So I think we should actually shrink down the TAMs, right? More fixed income product, great. More equities, makes sense. Commodities make sense. Broad pieces of the real estate space, I feel, do not deserve to be tokenized.
There needs to be a two-sided market.
Yeah.
So I'll go on the other extreme. We're happy to tokenize anything, right? And I think the smarter thing is not just pay us, we'll tokenize it and go away, but like, it depends on what your market is. Like, to your point, yes, it has to be something that institutions or retail actually want, but if you figured out a closed unit group where it makes sense, we've had clients come to us and want to tokenize racehorses. And the one that I have a moral issue with is that tokenizing investment grade wine, mostly because I think wine should be drank and not invested in. But like, beyond that, like, if that's what's cute and exciting, sure, but are we going to lead as an industry of the tokenized racehorse and the wine? We should all jump out the windows, right? It should be real markets that make sense.
I'm going to take the other side of that. I was going to say, do not tokenize collectibles. We've been through that phase before. A piece of artwork, a piece of your watch, a piece of a racehorse. It's just, at the end of the day, these are financial assets. And I think a lot of times we've seen crypto or blockchain applied to non-financial assets, but the real use case where there's liquidity, where people, the two-sided market, where people are willing to pay on the other side for that liquidity, for that asset, is in financial markets. And so there has to be a buyer. There has to be someone willing to trade it. We have seen so often people try to use collectibles, tokenized collectibles, as collateral for things. There's no market for it. We're not going to underwrite it. There's no liquidity. So I think at the end of the day, if you're in the business of tokenization and you can make money off of it, absolutely. If you're in the business of underwriting that risk, we don't want to see it. So I think both sides, two sides of each coin.
You're going to get attacked by all the NFT owners out here.
Well, thank you everyone for your time today and for your thoughts. Really appreciate it.
Thank you, Purvi.